We will continue with our presentation and then end off with a Q&A session. We are going to start this section of the presentation by briefly covering the concept of tax residency. As financial advisors, you will certainly be aware that advising clients is not always a cut and dry exercise. As the world is evolving, financial products are becoming more and more sophisticated, and clients are also migrating more and more freely across the globe. This may put you in the tricky position of assisting a client who is in fact no longer tax resident in South Africa, but may still have ties to the country in the form of financial investments or income-bearing assets. So how do we assess whether or not a client remains tax resident in South Africa, or if they have taken up tax residency elsewhere? Tax residency is a highly complex topic, and there is unfortunately no checkbox approach that can be followed, as each taxpayer will have their own set of circumstances which will need to be taken into account. There are, however, some general principles that can assist you when you are looking at a client's scenario and you are trying to ascertain if they have ceased SA tax residency. I would also just like to note that there is often confusion around the difference between citizenship and tax residency. When we speak about the concept of citizenship, we are speaking to the legal concept concerning the place where a person belongs or comes from. Citizenship is often acquired by birth and cannot always be directly translated to tax residency, especially in the modern era where South Africans migrating across the world has become increasingly common. Tax residency, on the other hand, speaks to the country in which you are liable to primarily pay tax as a resident. The first thing to ascertain is whether or not a taxpayer is ordinarily resident in South Africa. A taxpayer may only be ordinarily resident in one country at a time, even though they may meet the definition of resident in more than one country. Put another way, a taxpayer can only have one primary country of tax residence. The concept of ordinarily resident is not defined in the Income Tax Act, and therefore we look to precedent as set by the courts. A few guiding principles as established by case law are as follows. So firstly, we see that tax residency can be seen as the country to which a taxpayer would return to from his or her wanderings. The second thing to note, as I mentioned previously, is that domicile or citizenship does not automatically result in tax residency, although it will be considered as part of a full set of personal facts. And lastly, where a taxpayer has intention to stay in the country past the point of a casual visit, this would amount to tax residency. So due to the fact that each country has their own set of rules regarding tax residency, it is possible that you may encounter a client who meets the definition of tax resident in more than one country. In this scenario, in order to confirm the client's primary country of tax residency, it is necessary for them to break residency with one of these countries. In this instance, a double taxation agreement, otherwise known as a DTA, may assign taxing rights, and one should specifically look to the tiebreaker clause contained therein. Applying the tiebreaker rules per the DTA is an annual assessment, and the administrative process with SARS would therefore also be annual. So we often receive questions from clients and advisors asking whether it is necessary to inform SARS that they have ceased their SA tax residency, to which our answer is always yes. So remember that SARS will be well within their rights to continue taxing your clients on their worldwide income, if to their knowledge the client remains tax resident in South Africa. It is therefore important that a client formally ceases their South African tax residency so that SARS can assess them as a non-resident going forward. So once a client has ceased their SA tax residency, however, this also does not mean that they can wash their hands of SARS for good, as much as they might like to. So remember that non-resident taxation would then kick in, meaning that taxpayers will be liable for South African tax on income sourced in South Africa, and that means that they will still be required to complete an income tax return with SARS should they meet certain criteria. So some of these criteria include if they sold assets that are subject to capital gains tax in South Africa, such as immovable property or assets connected to a South African permanent establishment, if they received rental income from a South African source, or if they carried on a business in South Africa. It is therefore also important to note that non-residents may therefore be taxed on cash elections and withdrawals made from their South African retirement fund. They may, however, be able to claim relief per the applicable DTA between SA and their country of tax residence. However, For retirement fund members who have since left the country and have formalized their cessation of tax residency with SARS, there is somewhat of a silver lining. Once these members have been formally non-resident in excess of 3 years, they can access their South African retirement fund savings in full. Felicia will briefly take us through the rules for members accessing their retirement funds when they meet these requirements.
The Revenue Law Second Amendment Act also included updates impacting clients who have ceased South African tax residency. This is an important legislative change to note when advising clients who are looking to cease tax residency and those who have already ceased. The Act clarifies that the cease to be resident requirements pertaining to the 3-year rule applies to all retirement funds except for the vested components of umbrella or occupational funds and all savings components. So in other words, the 3-year immigration rule is not applicable to the vested components in the umbrella or occupational funds. The 3-year immigration rule is not applicable to the savings component. However, the 3-year immigration rule is applicable to the retirement component. Members, including paid-up members, are entitled to receive a retirement component as a withdrawal benefit only after this 3-year period. So now that we have clarified some issues around residency, we will be discussing some key considerations when advising non-resident clients. It is, of course, important to get a holistic view of a client before the provision of advice. Firstly, we believe that it is important to establish the tax residency of the client as the legal and tax consequences flow from this. Secondly, which products the client seeks to be invested in is important, as all products have their own rules and terms and conditions. Knowing the product rules assists with aligning with the client's intention for their investments and to know what a client can and cannot do. For products where a beneficiary may be appointed, we believe that it is important to know whether that beneficiary is a natural person or a legal entity. This is important as some products have rules as to how a beneficiary may obtain a death benefit depending on their legal status. Lastly, we believe that the residency of the beneficiary is also important to know, as much like the client, that beneficiary's legal and tax consequences flow from this. For example, certain countries have what is called an inheritance tax, meaning that if a beneficiary is a tax resident of that country, they may be liable for this tax on receipt of, for example, proceeds that emanate from an endowment. When dealing with trusts and its beneficiaries, the following piece of legislation must also be noted. So in the past, it has been the practice of the South African Reserve Bank and the South African Revenue Service not to approve the release of funds when resident trusts make distributions to certain non-resident beneficiaries. On 23 May 2023, the SARB issued Exchange Control Circular number 3 of 2023. The circular provided that income and capital distributions from South African resident inter vivos trusts, that is, a trust that was established by a settler who is still alive, may now be transferred abroad, subject to tax compliance status process being successfully completed. In this regard, SARS then issued guidance on 1 August 2023, which outlined the process to be followed in order to apply for a manual letter of compliance from SARS. The application must be submitted to SARS via email, and due to the verification process being strict, approval will only be granted by SARS should, firstly, SARS be satisfied that the distribution complies with the terms and conditions of the relevant trust instrument, for example, the trust deed, and secondly, that the resident trust demonstrates that all South African tax liabilities in respect of the distribution were or will be settled. The next consideration for advisors outside of non-resident beneficiaries of local trusts would be the relevant rules that pertain to making payments to non-resident beneficiaries of death benefits across the various products. So in the case of retirement funds and living annuities, the benefit may be paid directly to offshore dependents and nominees or transferred into a living annuity in the name of the non-resident beneficiaries. Living annuity payments can be remitted offshore to non-residents. However, a couple of things to consider would be the South African tax implications of the living annuity income for the client, as well as any payment rules that service providers have regarding offshore payments. At Allan Gray, we facilitate living annuity payments to non-resident annuitants on an annual basis. In the case of the local unit trust or platform, as well as the offshore unit trust and platform, we may transfer the benefits into the name of the offshore beneficiary or liquidate the investment and pay the proceeds to an offshore bank account on the instruction of an executor. It is important to remember that there are some restrictions for the two offshore products, depending on the domicile of the various funds invested in, as well as the tax residency of the beneficiary. We would also not allow a transfer to a US person on the offshore platform, meaning that in this instance, the account would need to be liquidated first and then paid to the beneficiary in cash. If we look at the two endowments, both allow for the policy to be transferred into the name of an offshore beneficiary for ownership or proceeds paid to the offshore account of a beneficiary for proceeds. Except, however, it must be noted that there is a restriction on the offshore endowment relating to Guernsey residents. I'll now hand over to Meagan, who will touch on our last topic on the agenda.
Moving on to the last topic on our agenda, we will now be looking at the tax implications of distributions to non-resident beneficiaries of local trusts. The reality is that when providing advice to your clients, you may not only be facing the non-resident dilemma when it comes to advising clients who have since ceased their South African tax residency and are continuing to seek advice regarding their South African-based investment products. So many local trusts, especially family trusts, were created in the past for the benefit of South African resident minors, without the intention of seeing these minor beneficiaries emigrating across the world in their later years. The result is that the taxation considerations now needing to be addressed are for distribution of capital and income to non-resident beneficiaries from these local trusts. So prior to the amendments to the Income Tax Act, which came into effect on the 1st of March 2024, Section 25B of the Income Tax Act stipulated that income would be taxed in the hands of trust beneficiaries if the trustees distributed in the same year of assessment in which that income was earned by the trust, or if that income had already vested in the hands of the beneficiary. This was applicable regardless of the residency status of the beneficiary. In contrast, the 8th schedule stipulated that where an asset or a capital gain was distributed to a non-resident beneficiary, it would be taxed in the hands of the trust, and therefore only distributions of this nature which were made to South African resident beneficiaries could effectively flow through the trust. So post the amendments to the Income Tax Act, Section 25B of the Act has been amended to align the treatment of income distributions to the principles of capital gain distributions to non-resident beneficiaries, which is contained in the 8th schedule. The effect is now that both capital and income distributions to non-resident beneficiaries are taxed in the hands of the trust. Trust reporting has also become more onerous for trustees, as trustees are now also obligated to notify non-resident beneficiaries when a distribution has been made, as these beneficiaries may have reporting and subsequent tax obligations in their country of tax residence. Trusts are required to disclose information to SARS in their annual tax return, including the amounts distributed to each beneficiary, as well as their tax information and their country of tax residence. It therefore becomes imperative to confirm tax residency status with beneficiaries prior to any distributions being made by trusts, as it may impact the tax liability of the trust, and it may result in understatement or admin penalties being imposed should this information be incorrectly declared or accounted for. Based on these amendments, let us look at the consequences for a trust investing in a discretionary investment versus an endowment. So let's assume that this is a discretionary trust and no amounts have yet vested in the beneficiaries. If a family trust with non-resident beneficiaries invests in a discretionary product today, they will earn income in the form of interest and capital gains. Dividends would be subject to dividend withholding tax, and therefore I have not included them in this example. Should the trust choose to distribute this income to the non-resident beneficiaries, regardless of whether this occurs in the same tax year or not, these amounts will be taxed in the hands of the trust at a rate of 45% in the case of interest and an effective rate of 36% in the case of capital gains. The net amounts can then be remitted offshore to those non-resident beneficiaries. Let us now look at the tax consequences should a trust with both resident and non-resident beneficiaries invest in an endowment. The investment will also earn income in the form of interest and capital gains, but these amounts will be taxed within the endowment wrapper. If all of the beneficiaries of the trust are individuals, regardless of their country of tax residence, the applicable tax rates would be per the individual policyholder fund. This means that interest will be taxed at a rate of 30%, and capital gains will be taxed at an effective rate of 12%. When the trust then withdraws funds from the endowment, the outstanding taxes will be withheld by the service provider, and the amount paid out to the trust will be net of tax. The trust can then immediately distribute these amounts to its beneficiaries, and regardless of their country of residence for tax, these after-tax amounts will not be subject to further taxes either in the hands of the beneficiaries nor the hands of the trust. So this results in a significant tax saving in comparison to a straight discretionary product when it comes to distributing to non-resident beneficiaries. It is important to note, however, that if the trust does hold these amounts in a bank account or other investment vehicle before distributing them onto beneficiaries, any additional income earned outside of the endowment wrapper will be subject to the relevant taxes depending on the residency status of the beneficiary to whom the income vests. That brings us to the end of our tax and legal presentation.